All right, thank you everyone for joining us for an exclusive interview to our enhancements of the VIX Index sector trading. I'm happy to present Lou Alfieri. He's going to go over how he's achieved tremendous success using the signals that are presented in the VIX Index sector trading room, using his conservative approach. Again, very happy to announce Lou. He's going to go over his presentation. If you have any questions, please save those towards the end. We'll go over those questions at that point. Lou will be happy to answer those questions, or if there's anything for me, I'm also happy to answer those questions as well. So Lou, go ahead and take it away.
Hi, everybody. I'm Louis Alfieri. I've been in Mike's room for about 6 years, and I've been tracking his trades, and I discovered sort of the secret sauce that allowed me to take a conservative approach to his room. So I'm just going to talk about that more in the goals section. I'm going to do a quick introduction, then I will explain, the secret sauce, and then the rest of it is just basic risk management. So I joined Elliott Wave in 2018. I spent a lot of time in the education center, and I wasn't, and I can do fib pinball. I just prefer to let the analysts do it. They're much faster. I took a stock market course, investing trading courses, and while I was learning, I just basically traded in Mike's room because I didn't have to do any of my own TA or any work to make profits, just copying Mike. So that paid my bills. I grew the account and I paid my bills just by following Mike's trades for years. And that's what I'm going to share with you today. Now I focus on SPX and VIX, and Leo's room is in there as well. But Mike, VIX is sort of the second half of SPX. If you're an SPX trader, I personally think you really need to know what's going on with volatility, and Mike keeps me up to date on that aside from the trades. Now, Mike uses options, and so his returns are higher than most investors make in multiple years. So if we can get a 60% return on Mike's trades, which is not a high return for Mike, you know, basically I'm taking profits when my position doubles. And most investors wait years to double their money. And I've been able to do it in Mike's room consistently, not doubling my money every year, but I've been making outsized profits every year. I've grown an account from a small account that's no longer a small account. And I've been posting about this approach in the room for years. So it's not going to be new to people who've been in Mike's room. And when working correctly, the conservative approach, which is what I'm calling it now, the conservative approach trades some of the high returns that Mike gets for a higher win rate and a lower drawdown. I just prefer to stay in the green at all times in my account. And so I added some risk management rules to Mike's system to make consistent profits over time. And time is the second ingredient because we really are going to be going for base hits and not home runs. And we compound that over time. But more about that later. So Mike asked me to add my approach to the room. So I'm not replacing Mike's trades. These trades, I don't believe, are official trades. They're just trades that are mine and that we'll be doing together and that we'll be tracking. So we'll be able to track the performance in real time. The goals is to capture the heart of Mike's profits while limiting the drawdown that can occur. And just as a quick example, let's say we had a full-size position that went up 100, 200%, and I were to sell half of that position, getting my cost out. And then that position were to go on to be one of Mike's 700% trades, which happens every year. We would lose out on some of those profits because we had sold out early. But the benefit of that is we don't have a drawdown if the trade goes against us. So when I talk about base hits, that's what I mean. When I'm taking out profits at 60%, 80%, 100%, that's what I'm calling a base hit. Again, that's not what normal investors call a base hit. That's what they would call a home run. But the reason why I like Mike's room so much is because I'm able to take this conservative approach and still make these profits that most people just never see. And so the key then to getting up to where the returns that Mike makes is the time element. So, if I would love it if everyone just spent a year in the room, created it conservatively, if that's what they wanted to do, and just grew their account. And then basically the proof would be in the pudding. And it takes time because when I would go to a new trading room, sometimes I would catch it on a slump, and that's a hard way to start a room. So using the conservative approach, at least the accounts won't get too red to begin with, in case you do start when there's a trade that's not a winner. Not every trade will be winners. That's why I have this system that sort of incorporates the fact that some trades are losers and still keeps the account green. So basically, the next point on the slide is what I just said. Mike will outperform me. He's outperformed me almost every year. And that's been tested by other members as well. So they've been tracking and they've been able to confirm that. But the drawdown with Mike is higher than the drawdown according to the conservative approach, because Mike has a higher risk tolerance. He's still a young guy. I'm older now. So I just don't have the tolerance for red in my account. So we'll enter trades too early or late sometimes. We'll exit trades too early or late sometimes. And sometimes we will outperform Mike. So the disclaimer here is that the performance won't match Mike's because we're doing things a little differently. And the other goal I have with this system is to limit the subjective step as much as possible. In fact, there's a document that Mike and I are going to be putting out in the room that puts the trade plan on one sheet of paper. It's full of if-then statements. If this, then do this, else do this. That takes a lot of the subjective elements out of it. And when there are subjective elements, such as which strike to pick or which expiration to pick, then we're going to go over those in this presentation. And this is the predicate for the whole system. This is what I guess I mentioned as the secret sauce. From my tracking over the years, I've found that approximately 68% of Mike's trades yield a 60% return or more within their lifespan. And usually this happens early into the trade. And right now I can give you a great example of it. Because Mike has a trade on right now, we have some VXX puts that we bought last week that are doing quite nicely. The one time when I checked, they were up 30%. The last time I checked, they were up a tad over 40%. And so that's the point I'm trying to make. So it won't surprise me at all if at some point those puts are up 60%, because most of Mike's trades yield 60% return or more within their lifespan. And usually early into the trade, like is happening right now. So I leverage this to tranche into and out of positions. And I don't hold the entire position to expiration usually. So we capture some of these gains before expiration. So if a trade goes against us, we will hopefully have our cost out by then. And because I pick a later expiration, it's possible that, if the trade does go against us and we have a later expiration, we could still stop out. And having got our cost out, whatever we make on the stop loss is all profit. And that's kind of another way I keep the account green. There's no magic in the risk management aspect of this. It was all learned through years of Mike posting. And I follow a lot of what Avi says about tranching. So the only magic here is Mike's trades getting to that 60% return level at some point in their lives. And so because we tranche in and out, there's more than just one buy and one sell, but there's not much more to the system at all. So for someone working a day job, this is very easy to follow along. And now that I'm a part of the room, I'll be updating, I'll be giving trade updates every morning, sometimes in the evening if they're warranted. And then that will help anyone who might have missed an entry to get in or to, do whatever they have to do to join the trade. All right, now Mike is going to be monitoring the questions. So he'll be looking at the questions, and the plan is to answer questions at the end. But if Mike interrupts me, I'll answer questions before. Otherwise, I'm going to get right into it here. So here's an example where tranching out paid off. We had a trade recently, and they were SPY puts. And we entered this trade before February. It was the very end of January that we entered this trade. And then there was a weekend. I don't know if anybody remembers, but on February 3rd, the market opened down about 8 points, which was not even as bad as what happened the week before. And these trades were well in the money. And Mike posted that, we're up 200%. He said, we don't want to let this trade turn into a loser. So I had purchased the February 6th puts. And when Mike posted that, I was already getting ready to get out because, the market really did sell off that morning. So I was already planning my exit. Mike posted the exit. And I guess the point I want to make here is that taking profits when we're up 100% or 200% is not my invention in the room. It's basically Mike's position that we do that. And so I've just been consistent with that and always done that. And Mike will almost always, and I can't remember him not posting. And so for anyone who misses the opportunity to take profits, Mike will post, and now I will also be posting. So it'll be hard to miss the chance to make profits. But here's an example where it paid off to take those profits. Because being up 200%, I sold half the position on that February 3rd. Sorry, it went past me there. Okay, I sold half the position on February 3rd, and I had made a 200% profit on half the position. So the rest of the position could go to zero, and I would still have made money. But what happened was the trade did turn against us. SPY recovered the very next day, and even part of that day. And so the February 4th expirations were not yielding much profit anymore. Meanwhile, I had the February 6th expiration, which still had a lot of time premium left on it. And so when I did end up closing those, I was able to, that was all complete profit, plus the profit I had made from the first tranche. And so that's an example of how a trade can go against us, but branching out early really paid off because this was a very green trade for me. But anybody who stayed in till the end would have probably gotten out at break even. So there's one example of what I do. And here's another one. So this is I don't know if Mike, if you want to comment on this setup at all, just chime in. Here's an example of where taking a later expiration paid off. So Mike put this trade out. If you follow, this is a workup in case no one's ever been in the room. Mike provides us, when he puts out a trade, he provides us with one of these workups, and we can choose our expiration and we can choose our strike based on the workup. And what you do is I'll explain exactly how to pick an entry in a minute. But what I did was, because the returns were so good, they were somewhat similar, but they were twice as much if I had gotten the February 28th. So I bought half of February 28th, was half a position, and then the March 7th were another half a position. And in this trade, like usual, went our way immediately, like the trade that we have on now is doing. And so this trade was up immediately. And on February 28th, which was that Friday, we were able, whoever had the February 28th expiration was able to get out with a decent profit. I'd say it was about 60 or 70% profit that they made. But I still had the March 7th, and I didn't sell those because it looked like VIX was moving up with velocity. And those blew out even the expectations from the worksheet. And so I sold them the next week, and those made about 250% profit. So I was able to get extra profit if but it wouldn't have done that if I had just taken all of the February 28th. So I guess my point is, it worked in our favor this time to take the later expiration, but it can work in our favor other ways as we're able to stop out in case the trade didn't go our way. So this taking a later expiration is just nothing miraculous. It's just normal risk management. And the rest of it is sizing. And we're going to go over all that next. So now I'm going to get to the system. This is the conservative approach. And the first thing I want to talk about is the entry. Now, we just had two examples. I'm going to go over this other example quickly here. This is an example from back in October. So Mike put out some QQQ puts. And if you look, the dates are October 11th, October 14th, October 15th. So this is just a weekend in between these 2 days. So this is just one session apart. And so for one session, they wanted us to pay, about 50% more than 50% more for the strikes. And the reward was not, in my opinion, was not compensating us for just taking on one extra day. So this is an example where I would pick the earlier strike. Unlike the slide before, where this February 28th, March 7th, March 14th are all a week apart. So by taking the later strike, I was able to get 7 days. So you see, it's just regular logic. There's nothing magical in any of that. And this is from the handout that Mike and I are going to put out. I'm waiting for Mike to give me final approval on the text. And we will put this out, and anyone can use this is a trade plan on one sheet of paper. Anyone can use it, anyone can copy it, anyone can use it as an example of a trade plan. But I find that unless it's written down, it's easier to break rules. So this is all written down. We're starting with step 2 because step 1 is sizing, and we're doing that next. So I'm just going to go over this quickly because again, this is going to be a handout that we're going to be putting out. So the first thing I do is what I just showed you. I compare all 3 expiration dates, determine how many days to expiry for each. I know any strikes that are highlighted. Mike really can't recommend which strikes we take. I believe that's just the law. And so, but if you notice, he highlights attractive strikes. So I noticed that any Mike has highlighted. And then I select a strike for each expiration date. And I compare the maximum and minimum returns for those strikes because Mike has returns on the workup. Let me go back to it. He has a maximum return for if we're in a wave 3 or some kind of impulse. And then he has a minimum return for if it's just a wave C or some kind of corrective move. And so you want to pick a strike where if it is just a corrective move, you still want to have green. Here, they're all green, but you can see some at the bottom are red. And so you just look at all these factors when you're picking an entry, and basically you try to get as much time as possible if it's cheap enough and the return is good enough. That's the criteria. That's the subjective part. And that's why I walked you through a few examples. And so if the min and the max returns for a later dated contract are satisfactory, and the difference between time to expiry from the previous selection is worth the additional expense, then buy the later dated contract. Note that if the risk return on the earlier dated contract is too enticing, buy some of each. So it's not a one or another deal. You could do either. Okay, I'm going to keep this moving along. Now we're going to start to talk about sizing. So a real quick note about options risk. I'm just going to assume everybody watching this understands why options are more risky than shares, but time decay is a risk. So you want to limit the cost. So you want to limit the amount of money you're putting at risk. So you have to keep in mind that time decay is still a risk. These things are going to end on a date. But the convexity that options provide amplify the gains exponentially. So therefore we can make a lot. The key is to risk a little and to make a lot. I have seen so many people risk a lot to make a lot, and it works sometimes. But if it doesn't work, then you have to make up all that money that you just lost. So when we're doing this system, whether you're following Mike or me or yourself, it is really important to keep in mind that these returns are going to be outsized. So we don't have to risk as much. So if that helps keep the greed at bay, just keep that in mind. This way, the premium we pay is our total risk. And just like tranching into and out of positions reduces our risk further, sizing is one of the main ways that we control this risk. So with that in mind, we're going to talk about sizing. So this is from the trade plan that we're going to be handing out. This is just an example of suggested sizing. This is, if you're trading shares, because sometimes Mike does put out shares for VXX or SPY or something like that. We can risk a little more because we can put a stop loss in place and be fairly confident that the stop loss will work. With options, we don't have that. So, we would limit it to maybe something between 1 to 2.5% count, of your account size. Risking more than that, I would say, is not what I would do that way. So this part of the sizing equation is how you're going to size a full size position. This part of the sizing equation is, are we going to get a full size position or are we going to get something smaller than a full size position? So up here, if you can keep your sizing of a full size position in check, then when you decide to put in less than a full size position, you're further reducing your risk. So it's just another way to reduce risk. So this is two ways risk is built into the system. We keep the overall sizing of a full position small, and we don't jump in with the full size position right away unless it makes sense to do so. That's where the if then statements come in. So this is a general example of how I go through whether I'm going to enter a trade with a full position or a half position or something else. First, I check with Mike's post, his original post where he posts the setups and the charts. Did Mike say that he was entering small size, which he'll do often, or starter position, lotto, anything like that? If yes, then just simply copy Mike. And one of the reasons I took risk management to heart so seriously is because Mike made an off the hand comment once that he doesn't even like the word lotto, even though we use lottos. So I just took that to mean that Mike is very against taking risk. And that was sort of the start of this whole journey because I'm like, why would Mike mention that? And anyway, this is what's been the product of that. The next thing I ask is there less than 5 days to expiry? Then I consider entering with a half size or a 3/4 size position. If Mike doesn't mention anything about sizing, or if Mike says he's entering a full size position, then I have to find a reason not to enter a full size position. So I ask myself, am I entering this trade late? Basically, has price gotten away from me? Or is there less time to expiry? This next question really is, has price gotten away from me? Has cost basis changed a lot since Mike posted it? If that's the case, I might not enter with this full size like Mike had entered because Mike got a different price. Do I already have similar positions in my account where this new trade imparts outsized risk? This is a very important question to ask. There are times when we have a setup, a great impulsive setup, say, and Mike will put out a workup at the beginning of the setup. Then he might put it out on a retrace. He might say, here's an updated setup. And then if we pass the wave one after the retrace, it's possible there could be a third trade. Or if you have two, it's like we could have a QQQ call trade, a SPY call trade, and a VXX puts trade. Those are really all the same trade. So if you were to take those 3 trades with a full size position, then you could, and the trade goes against us, then we would be out 3 full size positions. We would have to have 3 successful trades just to make that back and then worry about making profits past that. So I don't do that. So if Mike is saying this is a starter position, I take him seriously and I'll put in a half a position or 3/4 because it's possible we could end up with 1 or 2 more similar trades and I want to have room to add. The downside to this is if there's no further trade that comes out and I don't add to my position, it's possible on the Friday of the trade, on the Friday of the expiration, the trade just flies. And I've seen that happen. And I've just had to sit and watch. And so now we're always going to leave some of the trade trailing and we'll exit the last tranche with Mike so we don't miss out on those very exciting runs. The other thing I ask myself is, could this position serve as a hedge for other items in my account? So if I'm trading in my Roth, for example, which is what I do, and I have a couple, and let's say I have a bunch of growth stocks in there at the time, and we're taking, and I already have 2 SPY call trades open. I would not put a large trade in my account to add on to that risk. And I would also, if Mike put out a put trade, I might put a little bit of a larger position in my account because it can serve as a hedge for my overly long account. So I think about the account as a whole when I do my sizing. And then if any of these things are true, I consider entering with a smaller size, or like I was mentioning, maybe a larger size. Otherwise, I enter at full size. So I'm going to move on from sizing now. Again, this is going to be handed out to everyone in the room. And now the last step is closing the position. And this is where the 60% rule comes into play. Remember, 68% of Mike's trades, based on my tracking in the past, reach 60% profit at some point in their life, and usually early on. So if a position does hit 60%, I ask myself, has it become too oversized? I mean, it's some of these things do grow quickly. Then I might just take some off because the profits are just so good. The second question I ask myself is, has this gain come immediately after opening the position? Then I consider trimming it. Because if Mike puts out a trade and that same day or the next morning, we're up 100%, I take it as a gift, I get my money out, and then I let the rest of the trade, the rest of the half of a trade run its course. Because it's it's almost it's just almost bad luck not to take it at that point. And then I ask myself, is there plenty of time left before expiry? If so, then I might let the 60% get up to 80 or 100 or 120 or 150. It's very rare that a trade gets to 150 and I haven't taken out a third of it. So I've usually trimmed the trade by then. And then we can relax knowing that no matter what happens, we've made money. The other consideration I have for closing the trade is, as expiry approaches, I check for special factors such as, and this would be where you would probably enter your own questions into the plan, because for me, my broker closes options at noon if they expire that day. So if I had that, if I have those calls on February 28th and those VXX calls were flying and making more and more and more money, I would be more likely to roll them than close them. Otherwise, I would close them because my broker's going to close them at 12 o'clock, no matter what the price is at that point. So that's a consideration I have for me. And I will not be letting this little limitation I have with my broker interfere with any of the trades that we put out. The other question I ask is, will I be at the computer? Will I be around? If I'm not going to be around and expiring is approaching, then I might exit the trade, or I might set a limit order. I ask, has the position become oversized? Because that's always a good reason to trim. If any of those are true, I consider closing all or part of the position early. And then the last thing to consider for closing the position is if the trade fails or if Mike otherwise closes it, and or if it invalidates the setup and I still hold an option that is a week ahead or 2 weeks ahead of Mike, then I try to find a reason not to stop out. For example, with those VXX calls, Mike had closed his trades on February 28th. I kept some for March 7th. They kept running, so I saw no reason to stop out. And, I just raised my trailing stop mentally as we went along. And it's like I said, there's no magic here. It's just simple logic, when to enter, when to exit. It's just a simple trading plan that works. And it's been working for 6 years. So I want to go over risk management briefly, quickly, um, because like I said, risk management shouldn't be new to anybody at this point. So when I think of risk management, I start as what is my risk profile? I look at a bird's eye view of my finances. I have a house I own outright. I have a very large portfolio with Rita, a high dividend portfolio with Rita Mora. And that is a pretty stable, all that, the house and the Rita Mora, that's very large. And that, I mean, it's not very large compared to millionaires, but it's large. And that makes up the bulk of my assets. And then I have a Roth that is about $100,000 where I have some growth stocks in it, and I take Mike's trades in that Roth. And so I don't intend to lose $100,000 of that Roth. And so the way I do my sizing rules is I have it so that I have a maximum of $20,000 of my Roth at risk. So in that sense, I'm a bit of a small account trader still because I keep my sizing to those rules. And I'm about to show you the hypothetical returns from that in a minute. The other risk factor I want to mention again, so that's your risk profile. You get your bird's eye view of your finances. You see where your risk is. You don't want to, if you have no risk at all in your life, and you have lots of capital, you could maybe go to 3%, 4% if you wanted to, if you'd be able to replenish the account. So you have to take the bird's eye view into account. Then you think of the risk factors, and for Mike, the risk factors are time decay. So that is, and we've talked about that already. The other factor you want to take into account is your loss tolerance. And, as I got older, my loss tolerance has gotten smaller and smaller. And plus, I've been spoiled with Mike's room. So I really enjoy seeing green pretty much at all times. And so I have a very low loss tolerance. And so I keep my sizing in accordance with that. So then I come up with what is my risk management plan based on that. Remember, there's some risk management built in. There's actually a lot of risk management built into the system because we will often be taking the later dated expiration and we will be tranching into and out of positions. So we won't be losing a full position every time. And we won't, and we will, and again, the flip side of that is we won't have a full size position in place sometimes when these things take off on the last day. Our sizing can handle the rest. So we have built-in risk management here. I mean, for anyone who is following the conservative approach, they would have some built-in risk management. The sizing handles all of the rest. And then you have to ask yourself, is the conservative approach right for me? If you want to take more risk and you can afford to take more risk and you're informed and you still want to take more risk, then you can follow Mike. You could just simply follow Mike, or you could even go larger. I mean, it's all up to what you want to do. The conservative approach is right for me. And from what I've seen in the room, I think it would be right for a lot of people. Because like I said before, the returns from Mike, even being conservative, are just way more outsized than just your average 401k person can get in a year. And so that is what I take to the bank. And here's an example. Okay, so let's say you take all of Mike's trades And, we use the conservative approach and we average a 60% return on trades for the year. Mike puts out 4 to 5 trades a month, or that's the stated goal, is to put out 4 to 5 trades a month. Sometimes we put out more. He rarely ever puts out less. So 5 trades a month would be 60 trades a year. If you were to be putting in $500 a trade, forget about the percent of your account for a minute. We're going to get to that next. But if you were putting in $500 a trade and you were to do 60 trades a year, that's $30,000 you would be outlaying. The profit on that at 60% average return would be $18,000. Just to keep it real, I'm taking 15% off for user error, meaning, I can make a mistake. You can miss the entry, you can miss the exit. So there is going to be some play there in that number. So I'm taking 15% off just for that sort of unavoidable error thing. And that puts the profit still at 15,300, or approximately 50% on your cost, the 30,000. For a $20,000 account, $500 a trade is 2.5% per trade. With 2.5% per trade, the account can withstand 40 losses in a row. Now, I've never seen anything like that. I've always planned just for 7 losses in a row. That's my worst case scenario, 7 or 8 losses in a row. So I've never seen anything like 40. We've never even, I think maybe once we hit the drawdown of 7 losses in a row over 6 years. And so if you were to do your sizing at 2.5%, you would still have most of your account, even in a very bad drawdown. And personally, that's what I like to see. So for that same $20,000 account, a profit of $15,300 is a yield of 76.4% on the 20,000. That is indicative of how I've grown my account with Mike conservatively for years. So and that's not a promise. If we were to let's say that the 32% of the trades that don't go to 60% all go to 0. Let's pretend that that's a total loss. And then let's pretend on the rest of the 68% of the trades, we have a limit order to sell at 60% return, and every trade is gotten out at 60%. So that would be out of 60 trades, 19 trades go to 0. 41 trades are only 60% return. In that scenario, you would still make 12% on your $20,000 and slightly eke out the S&P return for that year. So I'm not saying we're going to make 76.4% every year. I'm not saying that at all. That's on a $20,000 account size. But what I am saying is the returns that I expect are, at least relative to the S&P, green. So in the scenario that I just mentioned, where 19 of the trades went to 0, we would still be beating the S&P. That I consider a win. But then again, this is more indicative of what I've seen. So just real quick, I'm going to run through this. If you have a $100,000 account and you don't want to risk 2.5% of the account, and you used 1% of the account value per trade, that's 1,000. So we just double everything from the last slide. And if we did that, so the cost basis would be 60,000, the profit's 36, take off 15% for user error, you get a profit of 32,300. That is a 32.3% yield on $100,000 using just 1% of your account. So if you're a millionaire and if you like this sizing, you could just multiply everything here by 10, and you can use these numbers as a guide based on your account size to see what you're willing to risk. Okay, that actually is the end of the presentation. The next two examples were just placeholders. So I don't know if Mike wants to take it over now, but that's pretty much all I have to present.
Thanks, Lou. That's really great information. We'll go ahead and open up to questions. So we do have some questions in here now. If you have any further questions, go ahead and type them in there. Lou, I'll let you go ahead and
I can't see the questions.
you can't. Okay, so I'll read the
Yeah,
questions out to you, and
yeah.
then you can go ahead and answer. Okay, so first question, it's very hard to get your recommended price unless we get early notice. So how much do we pay up? So what's your experience been with that, Luke? Because you've been, a member in the room, so you've seen the trades come through. And I'll just note that when I personally make the posts in the room, I don't take any trades until I make the post. So from the time that I run the workup, save the images, post it to the room, that takes 2 or 3 minutes. So sometimes the price does move in that time, and there's oftentimes when I'll pay up for a trade, and a lot of times I would say probably the majority of times, by the time I post a trade, I enter the trade. A lot of times the trade price has actually gone in the opposite direction, and members have gotten better prices than what I have because the prices come back down. But Lou, what's your experience been on this, and what would your thoughts be on how much you're willing to pay up on a trade?
Well, before we started doing this officially, I would be away from the room during the day, and sometimes I would have to wait even till the next day to enter your trade, and price does get away from me. But that is actually also a testament to the predicate, because the predicate also says that when your trades go to 60%, it happens early on. And so I'm kind of used to price moving pretty quickly after the trade comes out. And when that happens, let's say that the price moved up 10% past when Mike posted the entry order. Well, what I'll do is if a full position for me is $1,000 and I would get a full position, I would get maybe 10% less. I would buy $900 worth. And then if the price came back down, I would use that as an opportunity to sort of make that back up. Otherwise, I could live with being in the trade at 10% less. So if that helps.
Yep, that's great. Thanks, Lou. So next question. This is a great question, and I think a lot of people want to hear the answer to this one from your perspective, Lou. There was a record-breaking losing streak last year where most of the trades started down, so there was an opportunity to take profits. What size drawdown did your account suffer during the streak using a trade management strategy? Now, I'm just going to, before Lou answers that, I do have to note that we have to be, we can't discuss actual performance, but Lou can give some kind of guidelines on how he managed that losing streak last year.
Okay. Yeah, this is an easy explanation. 2024 actually started out very strong. So we had a first half of the year that I was I was well in the green. I was well in the green. And then there were, I mean, this is the only time I can remember hitting that max string of losses that I talked about. It was 7 or 8. I don't remember right here, right now. But of those 7 or 8 trades, 7 of them were similar. These were trades over a long time frame. So some of them were a couple months out, which is not usual for Mike. Usually the trades are for a week out, 2 weeks out, and they move quickly. That's sort of one of the hallmarks of Mike's setups. And so, I mean, I can tell you exactly what happened was there was an IWM trade put out, and that one had a 2 month time frame. And so I bought some of those, and I bought a later dated expiration at that. So my position was for a long time. And then on the micro count, there was another IWM set up in the same direction. And so Mike put that trade out. I nibbled on that one. And then another setup came from the same pattern that Mike was seeing on the chart. I wish I had the chart in front of me, but and so he said, it really looks like we have like a 1-2, 1-2, 1-2, or whatever it was at the time. And so Mike put a third setup on the same trade. I didn't take that third setup, but what I did notice was that because of time decay, the price came down on those options that were 2 months out. So I just bought a few of those. And so every time a trade came in the same direction as that, whether it was through volatility or whether it was another equity trade like the Qs or the SPYs, I just sort of just kept nibbling on those IWM, and I don't remember if they were calls or puts. That I don't remember, but I'm just going to say calls right now. So I put out. I just sort of kept adding to those ones that I had that were 2 months out. So really, all I had was one nibble that I'd taken on the second trade Mike put out that I mentioned, and that was a loss. And then I believe we had a loss on those trades that were 2 months out. So I didn't put full position into all four trades, and there were more than four. And I kept posting, don't do it. Mike would even post, say, we have Mike will always say that when we have other trades that are in the same direction or similar trades, he'll say, we already have exposure, to this move. And so he'll tell you to limit the sizing. What I do is I just always limit the sizing. And so I just always follow the rules. That's one of the things about having it written down. So I didn't lose nearly as much as a lot of people who I know came because Mike had a great winning streak in the beginning of 2024. So tons of people flooded the room. And then that's when it was a downside setup. I remember now. There was a big downside setup in the equities, and there were a lot of setups for that. So by not taking all the setups and by choosing a later date option, so I always have something on the table if the move plays out, I was able to keep my cost basis down, and I ended 2024 nicely green. I mean, it was the lowest profit I'd made in Mike's room over 6 years, but it was still profit. And it was good profit. It was good enough. And so that's what happened to me in 2024. And so anyone who was following me then or listening to I mean, after that, a lot of people now listen to what I post. But I mean, anyone who was following me then didn't lose, you know, every trade because we didn't take every trade. That's how the returns are different than Mike's. If that helps. I hope did that answer the question, Mike?
Yeah, I think so. That was a great explanation. Thanks, Lou. All right, so next question is, does Mike send, where'd it go? Sorry, I just lost it. Does Mike send these alerts as part of the market alert service? This is a separate service. It's called the VIX and Index ETF trading service. It's an add-on service as part of the flagship service, and you can add that under your services tab. Next question. This one's going to be for me. Can you include high versus medium versus low probabilities in the recommendation? So when I do post a trade, I will note what I'm seeing on that. As a general rule, I see a lot of setups. I see, I'm always scanning charts. So I may not be posting too much in the room, but I'm always behind the scenes scanning charts. So if I post a trade, I'm viewing it as a relatively high probability, unless it's just a really short day type trade where time is just really a big variable. I don't post a lot of those. I did earlier in the year. There was not a whole lot going on in the market as far as multi-day setups. So I took a few of those intraday setups, and I noted that in the room that, hey, these are going to be higher risk just because of time. Time is when you're dealing with a same day trade, you really are kind of at the mercy of time. And so I did take a few of those, but those are not very frequent. Otherwise, if I post a trade, it's a fairly high probability setup. I just don't post trades that I don't view as high probability. I won't post them. There was a point, I think it was the end of 2023, where we went, I think the entire month of December, where I didn't post one trade, and that was just because I just didn't view anything as high enough probability to worthy taking, risking capital on, and that led to an incredible first part of 2024. We were able to preserve our capital and wait for those high probability setups. So if I'm posting a trade, I'm viewing it as a relatively high probability. All right, corresponding symbol for VXX on Thinkorswim. I don't know. I don't know if you know, Lou, on that. I have no idea.
For
Thinkorswim.
VXX on Thinkorswim, I use Thinkorswim and I use VXX.
Yeah, so VXX is the answer.
Yeah.
What were your best and worst yearly returns on TCA? Again, we can't, unfortunately, now that Lou's an analyst, he can't, we really can't talk about his past personal performance. It's just a rule that we have in the site. We just unfortunately can't talk about his actual returns. Unfortunately, he's made some posts in the room when he was a member, I think, but we just can't. Unfortunately, now that he's officially an analyst, we can't disclose. We can't really talk too much about the actual returns. Is the VXX the same as iPath, ETN, linked to S&P exchange traded note VXX? Yes. Given where our near regime change, multi-year decade top, do you expect it would be harder to trade in the next few years than the last few years? I think it's going to be, or I think we're going to come into a extremely profitable time in the service. I think that we're going to see a high number of setups with the increased volatility. I think this is a great time to be in the service. The increased volatility is giving us more and more setups. So the more volatility we have in the markets gives us, more movement in the markets, which is exactly what we want to see when we're trading with options. And this is, I think, going to be a great market for this type of trading that we're doing. It's also going to allow folks to really mitigate their risk by using options and planning what their risk is ahead of the trade, regardless of what happens with the market. So because we're using options, if the market goes against you, 10% overnight, you're only risking whatever you put out to that trade. So this is a really, I think this is going to be a great market for the service and for the way that we trade. Once we see the multi-year top in place, the increased volatility will only make more setups available, which we've already started to see. So as volatility increases, we have more and more setups more frequently. Lou, do you want to add anything to that?
No, I just agree 100%. I mean, I think the volatility, like you said, I mean, if the market's not moving much, we have a little bit of a problem. But your setups are short on time frame. So I mean, if most of the setups are in the 2-week, 1, 2, 3-week range, you don't need to see far out. So you don't really have to worry about macro as much. And I find that we do just as well, if not better.
All right. Mike and Lou, thank you for providing the visibility to the presentation. Question: are the setups easily translated to other instruments? Example: SPXW options on VX futures. As far as VX futures, yes, they would be. VIX is usually trading very close to what the VX futures are. We won't have the workups for those posted, so you'll have to run your own workups as far as what your returns are going to be. But as far as VX futures and SPXW, yeah, they should be similar returns to those. But again, we won't have the workup for those individual instruments in the room. When you compound based on certain percentage growth of total account or based on time period. So
You're asking me.
So when you compound I guess, is this based on a certain percent of total account or based on a time period?
Well, when I talk about compounding, I mean, the slide I have up right now is a good example. I really can't talk about my past returns, but every hypothetical that I've talked about is something that I consider realistic. I think that's I'm allowed to say. And so if you were to have this, and I think if I had $100,000 and I made 32,300 in 1 year, just in Mike's room, I consider that a lot of money personally. So I mean, I consider that a great return. And that's just with 1%. When I was risking more of my account size, when it was down around $20,000, I I was making more as a percentage account, and so I was able to compound faster. But time and the yield are both in the equation, so you have to take both into consideration. I mean, I need the whole year to make 32.3%. Like right now, this year, I'm up about 4 or 5% in the account, something like that. I don't know exactly because we have a trade going on and we just had two trades. And so, but it is somewhere in that range. And so if every, January, February, so if every 2.5 months I can make 5%, I'll be in somewhere where I consider normal for this, I guess I could say. It's hard when you can't say a lot.
All right, question, is replay available? Yes, there will be a replay available for this. It will be posted into the room a little later. Comment, I usually get a better price, just wait for the initial buying surge to pass. Yeah, and that's kind of what I've noted. A lot of times I've noticed that members who wait, or a few minutes are getting better prices than what I am. That's not always the case, but it does happen quite often.
And I don't enter the trades until after I posted them. I mean, that's a rule. Avi and Rich made that perfectly clear.
Yeah,
So,
and that's
you're not
and that's a
competing with
real,
me.
yeah. And like I said, sometimes the workup that will be posted in the room, it takes 3 or 4 minutes to get from the time that the spreadsheet runs the calculations. I'm able to create the images, post to the room. That takes a few minutes. So sometimes those workups the prices will have changed on those workups. But I've seen some posts where we have a potential return of 1,000%. Some of these recent VXX trades, which because of the ending diagonal, and when you have an ending diagonal setup, that's not uncommon. Ending diagonals are really my favorite setup to trade when using options, because ending diagonals are the only setup in Elliott Wave, and really the only analysis that I know of that exists that has a defined price target and a defined time target. I don't know of anything else that you can say that with that has a defined price and time target. Ending diagonals are the only setup that I know of that have that component. So they are absolutely my favorite setup to trade when using options, and it's not uncommon to see those types of from 700, 600, 700, 800, 1,000% returns. So I've seen some people saying, yeah, I wasn't able to get into the price. It went up, a few cents. Well, we're talking about 1,000%. We
Right.
don't need to get too overly, picky about price when we're talking about those types of returns. If you have to pay up 10% on that type of return, it's well worth it still. So. I'm not currently a member of the room and do not have experience with options. Is there help available in the room for a novice like me to figure out how to get started trying this approach? Lou, I'll let you answer that one.
Well, I mean, I would recommend reading a book and learning about options. I mean, the book I read on options was about, 50 pages long. It had big print, and it was enough to get me started. But I've been, not just with Mike for 6 years, I've been with Leo for 6 years. So those are the two rooms I've been with the longest. And so I've actually gotten very good at options. And I don't believe we can give individual financial advice, but I'm always there to ask questions too, if you were in the room and had questions. But I think that would go a lot better if someone did take, just an afternoon or like not an afternoon, but took a week with an options book or at least a weekend and learned about how they move.
And I'll add to that it's not necessary to have that experience, because it's good to have that experience, but you can get started in the room following the trades, because we are doing the most simple form of option trading. We're just buying and selling puts and calls. We're not doing any complex options. We're not typically rolling options. We're really just buying and selling puts and calls. So if you don't have any experience in options, I think this is probably the simplest room to get started with it. You just have to learn your brokerage system on how you buy and sell puts and calls. It's really simple to follow. So learning more about options is always a plus, but it's not difficult to follow these option trades at all. It's just buying and selling puts and calls. It's basically the same thing you do when you're buying and selling a stock. You just have to find the contract in your service. So more education is always better, but it's not necessary. And I think this is probably the most simple room if you want to learn options and follow trades. Let's add that point. Questions. Have you ever considered and or have any experience with expirations beyond 3 days? So this, as far as the workup goes, it's not necessarily 3 days. The way that that's set up is I'm using the most aggressive expiration date that I feel is reasonable for that particular setup, and then it will post the spreadsheet then posts the next 3 expirations. So on the VXX, those expirations are a week apart. On the indexes, they're a day apart, and that's just how they are set up. If it's a near-term option, they're set up a day apart. If we go out to a longer-term trade, they may be spread out a week or a month, depending on how far we go out. But the spreadsheet is just using the next 3 expirations based on whatever that instrument is. So VXX, they're a week apart. Indexes right now they're currently daily. So it just depends on what the setup is. So I'm just using the most aggressive, what I would consider the most aggressive, what I'm usually taking the most aggressive strike or the most aggressive expiration, and then I'll provide the next 2 to go along. As far as going out any further, I think it's going to get information overload. I think that it's too much information because again, if I'm taking the most aggressive expiration, what's going to happen is the ones that are going out much further than that, the returns just really aren't going to justify the setup. So and I always will, I will look at what those returns are, and I'm not, if you're only going to get 100% or 150% on a return, it's not worth taking the trade as the max gain. So that's why it's really not. It's most of the time you're going out, 4 expirations past what the most aggressive one is just not necessarily. It's most likely not going to be a setup worth taking. So that's why I choose the next 2. Is there a broker that can be recommended or heard good things about for options trading? I use TradeStation. I like them. I've heard good things about IB. Lou, you have a comment on that?
Oh, I've heard a lot of good things about Interactive Brokers. I use Fidelity. They let me buy SPX options before they open in the morning, and they handle options really well. They didn't used to, but they do now, and so that's what I use mostly. I mean, sometimes I'll use Schwab. That's it.
Question: do you take all trades? I think Lou went over that pretty good detail already. Or if that question is for me, if I post a trade, I am taking the trade. I can't recall, unless I note that I'm not, because I may see a setup that I'm already overexposed in a certain direction. I think there may have been a few times where I said, hey, this is a setup I see. I'm not personally taking it because I already have exposure there. But if I'm posting a trade, I'm most likely in it. What are the typical instruments for the setup express? So we use VXX, SPY, QQQ, IWM are the main instruments that we use. We have had a couple of gold and silver. I think we've had one TLT that I've posted. Those are the ones that I typically take, but mostly I stick to the VXX and the indexes. Those are just the instruments that I have the most familiarity with. I track them every single day on all time frames, so I have a lot of experience with those and I have a really good feel for those. So that's what I mostly take. If there's a really clear setup on something else, I may post that, but I just have a good feel for indexes and the VXX. So those are the ones I post most, that will post a lot in the service. What portion of the setups are generally shares versus options? Most of them are options. They can always be, these setups can be used for shares, but it's going to be an option-based setup for the most part. Lou, would you go outside of Mike's stated expiry, or would you say within the shown expiry? I'm assuming you mean the expirations on the spreadsheet. So Lou.
So he's asking if I would go past the spreadsheet.
Yeah.
I've never done that. So yeah, I've just never done that. I stick within the spreadsheet because, like you said, if you're taking the first dated option, that means you think that this setup is going to finish by then.
How many contracts do you usually risk for $1,000 at risk? It just depends on what the price of the contract is. It can be 10 cents, 50 cents, $1, $2. Usually they're no more than a couple bucks, and those are on the indexes. They can get up that price, but usually I think 250 is probably the most we've ever paid for a contract. That just depends on the instrument and what the contract price is. The highest probability trades are ending diagonal trades. Ending diagonal trades have the highest return because we can really define a price target. And when an ending diagonal is developed, just the personality of that is the market is not expecting the reversal. So they provide the highest returns. Once an ending diagonal confirms, then it's the highest probability setup to reach origination point. Once it's confirmed by breaking the trend channel, sustained break of the trend channel, then it's a very high probability setup that it will return back to at least toward very close to or the origination point. The trick with ending diagonals is to know when it's ended. That's the trick with them. So sometimes if you don't catch the very top of them, they can reverse very quickly and you will miss the trade. The nice thing about the VXX, because if you have an ending diagonal going to the upside, because implied volatility is already high, you often will be able to get a nice setup after it already confirms. So ending diagonals to the upside on the VXX are great because you still will be able to get a good price even after it confirms. But equities, may not be the scenario. So they're very high probability, very high return once they confirm. The trick to ending diagonals is to know when they've actually ended. That's the trick. Have trades been performing better this year compared to the latter part of 2024? I have seen that, yes. Video recorded, yes. How does IV enter weighted into your recommendations? It doesn't. I'm strictly going on what the price is at expiration versus what the target is based on our Elliott Wave setup. So that's solely the way that I choose trades. And if it doesn't make sense from a return perspective, I want to see at least 300% on the gain for the max wave 3. So if I don't see that, then I don't take the trade usually, and that's an IV is going to be factored into that number, but I don't look at the IV particularly when I'm making a recommendation. Can you identify what market conditions were responsible for losing streak in 2024? So what happened in 2024 is I was watching for a large ending diagonal to have formed in the markets. It looked like that setup was going to develop. I did not want to be on the long side of the market, given the fact that we would look to be in a larger ending diagonal. I don't like trading inside of ending diagonals in general. I really want to stick to the reversal of those ending diagonals. So I did not want to be long the market in a situation where I was seeing a ending diagonal forming to the upside, which would mean a strong reversal to the downside. And I was just wrong on that analysis. And so that's really what was responsible for that losing streak in 2024. I also took some longer term trades, which is not typically what I do. And that also kind of got to the point where we were stuck in some trades for over the longer time period, which kind of amplified the situation to where we were looking the wrong direction in the market, and we had longer term trades, which made it the losing streak more difficult. So I've kind of refocused my efforts this year and really refocused on the shorter time frame trades. So if we're wrong, we know we're wrong quickly, and we can move on to the next trade. And so far, we've had a pretty good start to 2025. If you use shares, would you use a leverage proxy? You could. The issue with using shares is that there's oftentimes these setups will invalidate the primary count, and because we're using options, we don't have to stop out, and we don't stop out, and we'll see the trade come back to life based on the alternate count. Typically, when I'm doing these setups, I will look at both the alternate and the primary count, and if I like to take trades where I've got an alternate count that is moving in the same direction as my primary count, so we can invalidate the primary count and still make money, even if the initial trade invalidates, because we're still having an alternate count moving in the same direction. All right, next question. Will there be calls and trades for swing traders who don't trade daily, rather catch fewer profitable trades, but those that tend to be longer running, like weeks or months? I think I just kind of reviewed that. There are some longer term setups, but again, I prefer the shorter time frame setups. It's just, it allows us to get into more trades. We know we're wrong quickly, and we can compound our gains better. So I prefer not to get stuck in longer term trades, but there will be some from here to there.
Personally, I think if you could check the room, in the morning and right before the close, it should work fine. I mean, that's been my experience. I mean, if you can, I would check it a third time around 2 o'clock, because some trades come out around then. But you shouldn't miss any trades or notices if you check the room, after the open and before the close.
How does this work for someone new to puts and calls? I think I answered that one already. So if Mike posts a workup and Lou likes it, he will follow up with here is what I recommend for the TC approach. Yes, that is correct. And we're going to be, right now he's posting it as an alert behind me. We're going to be implementing a system where it'll be in a table. And that should hopefully be coming out in the next month or so. But for right now, he's just posting a follow-up alert. But again, it will be in a more formal table in the not too distant future. For risk management, would you usually suggest buying both call and put options out for an index? No, because then we're not buying directionally. We're doing a different type of option trade.
Right.
Okay. Can you give a sample trade easy? The question is, can we give a sample trade? We can do that in the room. Again, each contract varies in price. I mean, they can go from 10 cents to $3. It just depends on the instrument, how far out the expiration is. I mean, the QQQs are trading at $200 and something. So those $500 and something. So those contracts are going to be more expensive. the VXX is trading at $50, so those contracts are going to be much less expensive from just a per contract basis. But you're going to just divide whatever you're risking based on whatever that contract price is. So if your risk is $1,000 based on your percentage, you're just going to divide that by the contract price, and that's how many contracts you buy. And we can go over that more in the room. That's the basic math. How many ending diagonal setups do you get on average per year? It varies.
A lot.
This year we've seen more. I think more than usual, but it varies from year to year. Also, Mazag, user Mazag, Mark has been really focusing on the ending diagonals, and he's been finding a lot of those in the sectors. So using naked options or just a combination of options. They're just simple buy. They're buying or selling puts and calls. So the total risk is what you're paying for the premium. For example, on page 20, you had no blue line. Okay, so the blue line is based on the minimum potential gain. So the minimum potential, I'm always looking for 100% for the wave C. That's where the blue line comes in. That's automatically generated. Sometimes if it's more than 100%, there's not going to be a blue line because it's more than 100% on that C wave. It's because the option workup stopped and it has an error. So what it's looking for is looking for the line below that's less than 100%, and it's going to go to the next line up. That's where the blue line is generated. So we went over that when instruments are used. So correlate with Avi, sometimes, but I really do my own analysis. Avi and I are usually on the same page, but I sometimes on the shorter time frame stuff, we may disagree on the shorter time frame stuff, but bigger picture, we're usually on the same page. I don't think I've ever done a leap.
And if you disagree, someone could always reduce their sizing. So sizing can fix a lot.
Again, ending diagonal percentage, I don't know. It varies from year to year and setup. When will we be posting an investment plan? Hope soon. We can probably get that out this week. Cash settled. All of the ETFs that we do are not cash settled, so you need to sell them. Audible alert. You can set audible alerts in the room. There's a way to do that in your settings. Average expiration 3 to 357 days. Usually they're about 5 days for the most aggressive expiration. We'll go over the contract. We'll talk about that a little bit more in the room as far as how to do the math on contracts. You only go long puts or calls, yes. Opening trade is always long, yes, and closing trade is always selling the long options. Yes, that's correct. Okay, so that's it for the questions, folks. Thank you all for joining us. Thank you, Lou. That was an excellent presentation. We will be posting that trading plan in the room in the days and weeks ahead. And look out for the trade table. We need to work on the back end on that. But in the meantime, we will be posting behind me with his alerts, along with his daily updates. If you have any other questions, please feel free to ask in the room. Myself or Lou will get to those questions and answer those. And I look forward to trading with everyone who's joined us and having a prosperous year and years ahead. Thanks again, Lou. Exciting.
Thanks, everybody.
Team, and we'll see everyone in the room.